Hello friends, this is Vijay Bambwani, and in this video I want to talk about why the market is falling on Monday to the extent that it is falling. You see, I'm recording this video at close to noon, and the market is still falling on Monday, the 5th of April 2021, even though the video will be uploaded on Tuesday. I can see a 400 point odd decline on the Nifty. And the bank Nifty, of course, has taken it on the chin. It's fallen relatively higher because of what's happening in the markets. Now let's basically get down to the brass tacks of what is happening. You see, it has been my experience, and I've been trading in these markets for 35 years, 28 of which are as a CEO and a founder promoter of a company that trades for a living. I can tell you that bad news seldom comes at one shot and does not go away all that fast, which means it comes slowly, lingers on before it actually leaves us. The news that I'm talking about is both on domestic as well as foreign triggers. Let's take the international trigger first. Bill Wang's troubles seem to be accelerating. Now, here is this family-owned investment vehicle that was reputedly, in the week before last, supposed to have lost $10 billion. Later on, it was escalated to $20 billion. And in the recent weekend data put out by some news flashes seem to have indicated that he has lost as much as $110 billion. Now, that's a staggering amount. Do note that $1 billion is roughly 7,200 crores. Now calculate $110 billion. Now this is the kind of leverage that he had deployed. Some people are talking about leverage of 500 times. Now that's a lot. If you have a buck, you're taking exposure of 50 bucks, which means that a little bit of adverse price move and your portfolio flies out of the window. That's precisely what happened. And Bill Wang's investments have started to unravel. Now, if history is any judge, or history is any indication rather, I can tell you for sure that this figure appears to be watered down, which means that by the time the ultimate analysis and the audit is done, you will find that A, the losses are bigger, and B, currently, they are hidden in the balance sheets and trades of a lot of other clearing agents, banks, etc., etc. You see, the reason why Nomura and Credit Suisse stocks fell was because many of Bill Wang's trades were carried in the books of these two bankers, and they were hidden as swaps. I'm sure Bill Wang has these masqueraded trades in many other entities as well, and the full impact of this will be felt over a period of time. Do remember that all international agencies tend to soften the blow to the market by releasing bad news in bits and pieces. This is the nature of the market, and it happens all over the world. Typically speaking, you'll hear bad news coming after the market shuts over the weekend, just as Bill Wang's data came. On the domestic front, we have seen a resurgence in COVID, and we have seen lockdowns being implemented in many parts of the country, not only the country, but many parts of the world. And the industrial output has fallen to its lowest after August 2020 as the lockdown begins to impact the production process. Now, this is something that we traders, or statistically minded traders, called clustering. Clustering would mean coming together of various data points, and bad news has a way of clustering. Is the bad news coming coincidentally at the same time? I don't think so. It's not necessarily so. It is just that this bad news existed but the feel-good factor was so high in the market that people tended to ignore all this bad news. And in spite of me, in my recent videos, been warning you that the markets might just correct, people I noticed were hell-bent on remaining bullish. Now, this is called, in behavioral technical analysis or behavioral science rather, this is called auto-suggestion. You suggest to yourself that all is well, all is well, all is well, like Amir Khan in Three Idiots, and you turn yourself into an idiot who actually believes that all is well and ignore all bad news that is looking you in the eyes, and you choose to disregard it. Now, does it mean that the long-term prospect of the markets or the targets that are being thrown around like darts on a dartboard of 30,000 Nifty, 50,000 Nifty, 100,000 Nifty will not come? I don't think so. I'm not saying that at all. See, first of all, when I talk to you through these videos, I'm not talking to you like a research analyst, even though I'm registered with SEBI as a research analyst. I'm first, foremost, and always a CEO of a trading company, a prop trading company that deploys its money in the market for trading for a living. So consider yourself as proxy board members of my company, and we are having across the table conversation, a chit chat, if you will. And those of you who are not minded like directors of a limited company will feel free to disagree with my advice. The comment section is open to you for voicing your opinion. Now, what I'm merely saying in this is that the Nifty at 30,000, 50,000 or 100,000 over a period of time, over the long run, is going to happen. But as the Wall Street saying goes, in the long run, we are all dead. When my dad gifted me a car, when I started going to college, I used to pay, if my memory serves me right, 5 rupees and 42 naya paisa for a liter of petrol. Petrol is now kissed 100 rupees and come down slightly. So over a period of time, everything appreciates. The first car that I bought was for 32,000 rupees. It was a Premier Padmini, a Fiat. Can you really buy a car, a brand new car for that money? No. The value of the rupee erodes because the rupee depreciates 3.5 to 5% per annum against the dollar. And that inflation means that everything costs more, including shares, including the PE multiples of indices, including the valuation of many commodities and prices, including bullion, base metals, and everything else under the sun. So all these levels will come. But ask yourself the question, if Nifty is 15,000 today and you are investing in the Nifty at 15,000, with a view that you will sell this once Nifty doubles, no matter how many years it takes. If it goes to 30,000, you're going to sell. But before 30,000 comes, if Nifty was to go to 13,000, I will bet for sure that majority of these so-called long-term bulls will be headed to the chemist to buy adult diapers. This is the nature of human behavior. This is nothing but basic common behavioral traits which we as behavioral traders understand. So a 2000 point decline in the Nifty will suddenly see a lot of negative comments and negative sentiments emerging into the markets, and where positivity was existing, negativity will replace the positivity. This is a routine business in the market. So erstwhile people who were extremely bullish will now make the mistake of being extremely bearish, and both the times they would have been proved wrong. It is you as a rational trader who needs to exist, survive, and last through these crises so that you can reach the 30,000 levels. It is precisely with this kind of an event in mind that I recently recorded a video. This is what I will do if the market falls. And thank you for all your love and affection and the comments that you gave in that particular video. This was really my game plan. This is really my game plan, and I would stand by it. I think what will happen in the absolute near term is that excessive greed, which was fueling the rally, will be for the absolute short term be replaced by excessive fear. And fear and greed both are illogical and completely emotional responses in financial markets. They are bereft of any logic. There is no logic in both fear and greed. Where there was unnecessary buying taking place earlier, there will be unnecessary selling which will take place now. And therefore, in the short term, statistical beta or pure price volatility will shoot through the roof. Now, these are aspects that I put out on Equity Masters Telegram channel every evening, late in the evening. I would strongly suggest you join this Telegram channel, which goes by the handle Equity Master Official, because this is very simple statistical data, but it will put you ahead of many players in the market. This is something that you need to think of as cool-minded individuals and not get carried away either on the bullish side or on the bearish side. Many years ago at a media event, I met a fund manager from Japan, and he told me, Vijay-san, the definition of stupidity in financial markets is doing the same thing over and over again and expecting different results. Let us all learn from our mistakes and don't repeat the same mistake over and over again, so that the only way the markets, by the way, rewards you or rather punishes you for your mistakes is give you a loss. So as we learn from our mistakes of the past and we don't commit them time and time again, we will ultimately come into profits. That is what we are here for, to grow, to evolve and metamorphosize as better investors and traders. And I hope I'm going to achieve that through these videos, and you're going to find this a good value add. Friends, I take your leave in this video, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon so that you receive alerts about fresh videos being put up out here. In the comment section, do let me know what you think of this video. Good, bad, ugly, I welcome all comments. And help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. I wish you have a very profitable day ahead. Vijay Bambwani signing off for now. Thank you for watching. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.